So the way a disability policy works is you have a monthly benefit, and that's if you become disabled, they'll pay you X benefit per month, kind of like a paycheck works. If you are disabled, you have to satisfy elimination or a waiting period. That's usually 60, 90, or 180 days. So from day of claim filed or usually day of disability, you start that waiting period, then benefit pays out. There's a couple different ways that they define disability. You have true own occupation, and that covers exactly what you do in your job. So if we can't do insurance anymore, but we can do something else, we'll get paid benefit. And then you have an any occupation definition, and that basically says that's kind of what I would call the hit by a bus scenario. So in any occupation, if you get hit by a bus, you can't work in any occupation, it's going to pay benefit then. But if you can go work in another occupation, you're not going to get benefit per se. The residual rider is a partial disability benefit. So if you lose a portion of your income, it'll kick in to make you whole again. So it's partial disability on that. And then you've got a cost of living adjustment rider, which pays a 3 or 6% increase if you're on claim. So that rider is a paid rider. And if you go on claim, every year you're on claim, you'll get an increase of either 3 or 6%, depending on which one you choose to your benefit. And that's just to keep up with cost of living. There's catastrophic disability rider, which that pays an additional benefit if you are deemed catastrophically disabled, which is loss of like sight or loss of 2 or more limbs, loss of hearing, and that benefit will pay an additional benefit. And the thought behind that is the additional benefit is like if something happens to you in that category, your cost of living is going to go up based on installing ramps in your home or just added costs to your life based on being disabled to that extent.